Sean Kidney is the CEO of the Climate Bonds Initiative, an international NGO working to mobilize debt capital markets for climate solutions. Here he has led many projects, including a green bond definitions and certification scheme with $34 trillion of assets represented on its board and some 200 organizations involved in its development and governance. Sean has also been a consultant on green bonds to the United Nations Secretary General and was previously an award-winning marketing advisor and a social marketer and publisher.
Nice, I didn't know they were going to do that. Very pleasant. Thank you for being here today. My name is Sean Kidney, as you've been able to tell. I'm going to talk a little bit about what's happening in the green bond market. You can see from the graph, something's happening. We have this market called labelled green bonds. Now, I want to stress that this is a marketing theme designed to create a large and liquid refinancing market for projects like solar that will over the time reduce the cost of capital. That's the ambition. We've deliberately taken an approach of saying green bonds rather than solar bonds or wind bonds so that we can create a bit of a liquidity through scale and size. This is what you'd call hypothecation, promises. The interesting part of this market is this idea, and I hesitate to use the word innovative here because my stakeholders, institutional investors, do not like innovation. They do not like anything exciting. They want it to be safe and secure. But a little bit of innovation here, which is that issuers who issue labelled green bonds, it can be anyone. It can be a corporate, it can be an asset-backed structure, it can be a sovereign, as France has, promise to use the money for something green, for qualifying assets. We'll get to the detail of qualifying assets later, but you know that solar is included. You can be fairly sure about that. As a result of that, we've done something for the socially responsible investment industry, which was proving to be very difficult beforehand. In 2008, the responsible investor industry, which is roughly measured at about $21 trillion globally of assets under management, had difficulty finding bonds they could invest in. In fact, they were hardly in bonds, they were mainly in equities. So this was ESG, environmental social governance screening. That became a problem in 2009 when someone realised they'd forgotten about diversification in SRI, and there was a rush to try and find some responsible bonds, if you like. Unfortunately, if you take an ESG screen, you end up having a very small pool of corporates with quite risky ratings to choose bonds from. So to change that came along this market. In 2008, the European Investment Bank issued a climate awareness bond. Now that was backed by the European Investment Bank. The proceeds were allocated only to solar, wind and related projects. Nice idea for Scandinavian investors in particular, or French investors, who had a great deal of difficulty finding AAA bonds to put in their portfolio because they do want a range of risks available, some diversification of risk. This was a boon, at last, the AAA issuer that we can put in our portfolio and still call it green or responsible or whatever. Now, they may have had some EIB bonds as well, but they particularly liked the idea that the funds were going to green. The World Bank issued a bond very soon afterwards called a green bond. In their case, they went to the same Scandinavian investors and they said, we would like to do the same thing. Are you interested? And they said, we're very interested, but. What do you mean, but? Well, you're the World Bank. Yeah, I know, everyone loves us, we trust us. But your CEO is called Robert Zolek, and he's not known for being green. In fact, he'd been the person associated with the controversy of building a coal plant in South Africa. So they said, we need someone to check your portfolio. But we're the World Bank. Okay, they gave in. They got the University of Oslo's Climate Change Research Centre to review the portfolio of loans they were going to make by getting this green bond. They changed some things because they had their loans to coal power stations to improve their carbon efficiency. The climate scientists said, hang on, I know that's a lot of carbon, but actually on our projections, our transitions projections, we have to get rid of coal entirely. We can't actually be investing in lengthening the life of coal. Okay, they took it out. Now, that was a very interesting point because that was the first time the World Bank had to confront this idea that despite the high carbon savings of investing in coal, climate scientists were saying, actually, no way, Jose, they've actually got to go in too tight a time frame. So if you invest in coal, you just extend the life. And in fact, under the new modeling that the International Energy Agency is doing for the Paris Agreement at the moment, they're saying that all coal has to be closed down from 2035. Very soon afterwards, it has to disappear. Gas and oil has to disappear by 2050. This is a much tougher trajectory than has been talked about before, especially by, of course, the oil and gas industry. There is no future for those fossil fuels under the Paris Agreement. Or at least there is for 5 years, but 10 years out, you've really got to be starting to get out. So that's the background. So this bond got reviewed. The independent review of the green credentials got established as a meme. Bingo! Great idea was born. Well, maybe. For a few years, we had a few development banks issue bonds, and there was an argument about price. So there's a bit of extra work in doing this. You've got to find a portfolio, you've got to describe it, you've got to walk over to the investor and say, look, it's really green. Look at all these really beautiful projects. The trouble is that takes effort. So the issuer would say, you've got to give us a premium price for this, a better rate as a result. And the investor said, no, you're giving me an illiquid instrument here. I need a 15 basis points benefit here at least. And the argument went back and forth over a couple of years. Well, the IFC, to their great credit, decided to try and break this logjam. In 2013, in March, they issued a $1 billion benchmark bond, which was flat price. That is the same price as other IFC bonds, but was green. That is, the proceeds went to all of these green things that we'll talk about in a little while. And it was 2.5 times oversubscribed in 1.5 hours. Whoa! That sounds like an interesting deal. That is, they had $2.5 billion of orders in 1.5 hours. They did another one in September that year. Everyone thought, okay, this is going to work. By November that year, we saw the first corporate green bonds. That is, this meme went out of the development world into the scarier, risky, less trustworthy corporate world, helped by the fact there was an independent review of the green credentials, removed from the institution, the bank. And that led to Wasser Kronen, Bank of America, Merrill Lynch, Engie. Hang on, Engie's a gas company. Those days called GDF Suez. It was 2.5 billion euros issued. Again, incredible sale, great price for Engie. They allocated the money internally within their portfolio. Money is fungible, but that doesn't matter. They had a portfolio of renewable energy projects, 2.5 billion euros going forward. At that point, we had the beginnings of a market, and now you've seen this growth. So in this particular market, it's worth noting there are different sorts of issuers. There are development banks, there are corporates, there are non-financial corporates, there are asset-backed securities in here. We have Toyota issuing bonds, we have Solar City with a large program of green bonds. Now, you might ask, isn't just Solar City a green bond? I mean, why is anyone arguing? Okay, this is a bit weird, I will admit. When I speak to BlackRock, the world's largest investor, they say, Sean, you've been saying for years, and we publish a report each year of HSBC, which says, look, if you're an investor concerned around climate risk, here's about $700 billion of bonds around the world you can invest in tomorrow morning. They're out there. Solar's a big chunk of it. Mid-American, for example, did 2 $1 billion benchmark bonds for its solar projects in Southwest USA a few years ago. Hey, they're green bonds. Come on, it's going to solar. And BlackRock said, you know, we really like the stamping, labeling aspect of it. We really like the independent review because that gives us a story to tell our clients. We don't need to be the ones judging whether it's green. And I know solar's green, but people still don't understand. And once you get beyond non-solar into rail and so on, how do we know? So just stick to the label, Sean, please. So what is this label? Well, this label, enshrined in the Green Bond Principles, which is a protocol set up by a bunch of banks, which we've been involved in, and the Climate Bond Standard, involves you getting an independent review. It involves you being transparent in a certain format. It involves you giving annual reviews about how the money is still being spent in the same correct promised area. Fairly straightforward. You get that, you get a green bond stamp, bingo, you make it onto a BlackRock's Aladdin system, which is their internal tracking system they make available to fund managers across the US. It is the most important bond tracking system in the world, as a green bond. So if you are an investor and you like the idea of green, You may not, solar, that's just tiny, right? But green, that seems big. Okay, let's have a look at green. You call it up, bingo, you get all these bonds. Mid-American doesn't appear there. Okay, it's stupid. Solar City does, because they simply follow the protocol. So far, so good. So what does it mean? You get more investors. It's as simple as that. So if you issue a bond under the green protocol, you will get between 15 and 60% more people knocking on your door than if you don't, as a rule, on average. Greater oversubscription levels. Now, if you're a clever treasurer, you would know that if you get 15 to 60% more investors to your register, you're likely to be able to eke out a bit of price. It sort of makes sense. Now, it may not be a huge amount, it may be 2 basis points, maybe 3 basis points. So this isn't going to be useful for someone who's doing a $10 million bond, right? But if you're doing $500 million, that can be quite a lot of money. If you're doing $500 million year in, year out, that adds up to quite a lot of money. And that is the market we've seen here. 78% last year, 155 billion US globally. We expect it to be around 250 billion this year. And we are looking at growth like that because the demand is so damn strong for this simple marketing idea. For those of us who are in marketing know that, of course, marketing is everything. And what we're trying to do and what we have successfully done here is create this idea of a big and liquid market. So it's no longer a niche solar market, because unfortunately solar is still niche for the institutional investors. You are now part of this 300 billion outstanding market. You are no longer niche. So when they buy a green solar bond, they feel, oh, they can trade it. Remember that liquidity is very important for institutional investors for regulatory reasons. They've got to be able to buy and sell quickly. If they feel there's a secondary market, they feel much safer. If they feel they have to buy something and they can't be sure lots of other investors around, that's the illiquidity premium. Oh, I'm going to have to get a 15 basis points better price before I consider that particular bond. It's a very simple proposition going forward. So what's behind all of this? Well, just to paraphrase a bit of what Christiana talked about yesterday, there's anxiety around climate change. Remember that the institutional investor market, pension funds and insurance funds, largely is made up of actuaries. These are folks that do actually worry about asset and liability matching over the next 20 to 40 years. The reinsurance companies, Munich Re, Swiss Re, have had climate change research centres for 25 years now, trying to figure out what to do. They know there's a problem. According to the Institute of Actuaries, it's a pretty sober body in the UK, 2 years ago, we will see on current trajectories of climate change, in 2050, wholesale portfolio decimation. Now that sends a chill down the spine of any actuary. The trouble is that their investment horizons, the way they run their funds because of existing portfolio management theory, are 3 to 5 years out. So they've got a long-term risk, they've got a short-term asset management problem, they don't really know how to square the two. They've been working on the insurance policy side of things. You have, for example, about 15 years ago, reinsurance exited coastal property in Florida. You can't get reinsurance that's commercial in Florida anymore. Mar-a-Lago, hey, no way, Jose, will Munich Re touch it? In their wisdom, the state of Florida, with the fabulous governor who doesn't believe in climate change, decided that the state of Florida would take on all that risk. So as a result, Florida, which should be a AAA state, has been, according to Moody's, notched down a couple of degrees because it's taken on this vast reinsurance risk, which is totally non-commercial. And as a result, people are still building towers right on the beach in Palm Beach, even though we know Palm Beach is sinking quite quickly, and in about 20 years, those towers will have to be evacuated. Hey, there's a lot of foolishness around. The main point is the actuaries are working on this. Now, they are concerned that we have this coming on. The grimness, as just a rephrase, that's just the argument we tell the institutional investors. Second half of this century, 4 to 6 degrees Celsius, warming, 10 degrees average over land, 4 to 6 meters sea level rising, according to NASA's Jim Hansen. Maybe we lose 1/3 to 2/3 of the world's population through a series of pandemics coming through year after year, which is what the World Health Organization thinks is likely. It's not a great future for our kids, let alone your portfolios to pay your pension. Now, I realize it sounds a bit mundane talking about portfolios and that scheme of things, but that's the target audience we have. I mean, don't get me wrong. We are absolutely here in a fight for our lives to create a future for our children. We do need to remember that. As we heard earlier, at the moment, we have failed utterly. The last 25 years, emissions have gone up, not down. The last 10 years, they've gone up faster, not down. What the hell are we doing? We are tracking at the worst possible trajectory of the International Panel on Climate Change's predictions. We are, despite the success of solar, currently looking at catastrophic climate change. That's according to the CEO of the International Energy Agency, Fatih Birol. Catastrophic climate change in the second half of the century. Desertification, collapse of societies. Think Syria and Somalia across the whole tropical zone. Think Pakistan, of 100 million people, vast pools of unemployed young men now running out of water. What will they do? Well, they have no choice but to try and cross the border. And therein lies another war. There'll be many of these the way we're going. And we won't be able to escape here in lovely Netherlands because of the pandemics that arise. We know already, looking at the last few thousand years, that whenever we've seen climatic shifts, sometimes human-induced, we have pandemics coming through. Now, we haven't seen anything in climatic shifts of the scale we're seeing at present. We are in the middle of a great extinction. We've already lost a third of our species in the last 150 years globally. We're going to lose another third very quickly in the next 100 years. So that's already happening. We're in the middle of that now. The question is, can we stop it getting really bad? But just a flavour, if you like, of how we've influenced climate already. When Christopher Columbus went to the Americas, the two great imports or exports from Spain he took with him were measles and smallpox. We now know, to our great surprise, that right across North America and in the Amazon, in places we thought were depopulated, were cities, not rural populations, not Navajos in India on horses, but cities. Within 150 years, 90% of the people in the Americas died from disease. When the settlers came across from England, they walked through lands that looked empty and pristine. They were because there were skeletons under the soil everywhere. A massive depopulation. Okay, germ warfare, we've had a bit of experience in other places. What we didn't realise is the massive forestry growth in that 150 years sucked a huge amount of carbon out of the atmosphere. And we now know that the mini ice age Europe experienced and the rest of the world experienced in the late 1600s was directly correlated with this drawdown of carbon. I mean, good news is, hey, we know how to draw down carbon. We've figured it out. We've actually done it once before. Massive regrowth of forests. That is one of the clues for solutions. The Thames froze over for the first time in recorded history in 1670. And we had the plague come through. And diseases. So that's what the second half of this century looks like, folks. The opportunity for us, the reason we're here, is we kind of know what to do, don't we? It's not as if there's rocket science. It's solar, it's wind, it's also mass transit. 23% of energy emissions are to do with transport. That means rail, by the way. Sure, it means electric cars, but that is actually not the great solution for a variety of reasons, because our cities also have to be denser. Hong Kong and Paris, not Los Angeles, for a whole regions of other kinds of carbon footprint issues. We know we need to do resilience. Singapore is already raising its ports 1.5 metres to avoid storm surge problems. Every port in the world is going to have to do that based on a reasonably livable trajectory of climate change. Forget about extreme volatility or catastrophic change, there's no hope there. So these are things that we know. There's very little R&D to be done. I mean, great R&D will continue to drop the cost of batteries, drop the cost of solar and so on, but that's coming in on the back of large-scale contracting. What we've got to do is large-scale contracting, large-scale contracting, large-scale contracting. That drives down the price of things. We know that from solar now. We're seeing that in batteries, where prices are dropping dramatically because of large-scale contracting. R&D comes in the wake of that. So we know what to do. We may not appreciate the scale. I mean, forget solar. In the next 15 years in emerging markets, we're going to invest somewhere between 60 and 90 trillion US in infrastructure anyway. And by the way, if we invest that in brown, we are dead. We are building cities of 20 million on a regular basis around emerging markets. They've got to be green. It's urgent. No longer can we even allow people to put 6-lane highways down a new city in Andhra Pradesh, where Amaravati, the new capital, which is meant to be very green, and it's very green buildings and lots of clean energy, has a 6-lane damn highway down the middle. Get our act together, guys. Make it light rail, make it transport, and of course cover the buildings in solar, which of course you guys will do. These are the things that we have to do at urgency. We need capacity in those cities. In Lagos, they don't know what to do because it is chaos. They don't have the capacity to collect taxes. It is a challenge. FMO needs to be in those cities, looking at governance issues, how we finance things. But in the meantime, we already have a few good ideas. To take transport, we know from Tokyo, from Hong Kong, that the ideal way to develop mass transit, this is an example of a financial viability model, is to do property development on the top of stations. You can't possibly, in Lagos or Mexico City, pay for the mass transit system without vast tax amounts by just the operating revenue. It's just not possible. But you can do it, as has been shown, in Tokyo, where railway lines, when they were developing Tokyo in the 80s, made deals with local landowners outside of Tokyo to share some of the profits from developing the land, and they built large shopping centres, commercial buildings and apartments on top of the stations, which drives traffic to mass transit. This has been working in MTR the last 10 years. MTR, the Hong Kong Transport Authority, is a 75% government-owned body, 25% listed on the stock exchange, and it pays a dividend. It pays a dividend to the Hong Kong government. That is very different to TfL in London, I can tell you. That is the model we need, guys. Hallelujah. And there are models in every sector, as you will know, for doing this. That's what we've got to export really fast to have a chance of a life for your children and my children. That's what it boils down to. And, hallelujah, again, sorry, I'm getting a bit religious today. We have the money. So I have 2 reasons for hope, despite this ghastly future currently laid out in front of us. 2 reasons. One is we know the solutions. You guys know the energy solutions. It is not rocket science. We just have to do it, and we have to get government policy in order, et cetera, et cetera. The second part is we have the money. We have this extraordinary moment in history. And in a way, you think, there lies hell and perdition. And at this particular moment in history, we have on this side the money. Can you believe it? How lucky are we that at this moment when we have to build $60 to $90 trillion of green infrastructure in the next 15 to 30 years, we have more capital on the planet now than ever before in history, and large swathes of that capital, huge piles of that capital, are in German bonds. Whoa. 0 and negative rate instruments. 21% of institutional invested capital in Europe is in negative or 0 rate instruments. And in Japan and in the US. I mean, I'm hoping to get a pension when I retire. Well, if I retire. At the very minimum, I want to get something. There's no way the pension funds can pay your pensions or my pensions on getting 0 interest rate bonds, right? There is no yield in Europe. And let's face it, there is not going to be significant yield in Europe for the scale of capital we have managed to amass through our pension and insurance schemes, amass in a very clever way. Now we have to deploy it. It needs to be deployed to infrastructure projects that have some yield. Bingo. How lucky are we? How lucky are we that the sea of money is sitting there? But it's not going to green adequately. At the moment, it is still sitting in German bonds. And that's the challenge we have before us. I spend a lot of my time talking to bankers. I tell bankers nowadays, guys, you know how in 2008 you couldn't go to a dinner party anymore? In fact, you still have difficulty going to a dinner party and saying you're a banker. People look, oh, it's lovely. You can now say that you're part of the future because it's a simple thing here. We have very large pools of capital over on this side, represented by APG, by PGGM, by AXA, by Insura, by Allianz, by AP4, by CalSTRS, by CalPERS, by the Government Employees Pension Fund in Japan that's announced that 10% of all its assets, $1.2 trillion fund, will go towards ESG investments, just announced late last year. It's a global thing. And over here, around this table, we have all the solar developers, all the rail developers, all the people with the solutions. $60 to $90 trillion of planning to be done, mostly held up by government policy challenges. Over here, ready to go. Who makes the bridges? Financiers and bankers. They need to be the heroes of our age. They will be the heroes of our age if the capital starts sloshing across. It won't come from the public sector. There is not enough capital by any imagination in the public sector balance sheet. However, we don't change a society quickly without activist public sectors. So what do the public sectors have to do in a war situation, say? They have to mitigate the risk so this capital can flow. They have to do things like guarantees, feed-in tariffs. But sometimes they just have to change the policy to make sure that it's not skewed in the wrong direction, right? I mean, it can be financial sector policy. Take quantitative easing in Europe. In a study by the London School of Economics, we found that the greatest beneficiaries of quantitative easing are, oh, just have a wild guess, oil companies. Oh, that was clever, wasn't it? How did we do that? Because they are legacy incumbents, they are able to borrow quickly, so as quantitative easing drove down prices, the incumbents, the legacy industries, got the advantage. It drove down capital for everyone else, but they got the best capital rates. So we've inadvertently skewed our financial system to brown in a huge way. We now need to skew it back. If quantitative easing, as we pitched to the European Central Bank, had a priority towards green bonds, bingo, that would create more space for the likes of solar. Now, the People's Bank of China is doing this. If you're a mid-level bank in China now, and you want to get access to the liquidity lending window of the central bank, every mid-level bank wants to get it because it's cheap capital, they can use green bonds as collateral, otherwise it's really hard to get access. Woof, easy. Suddenly I've got mid-level banks phoning up from Shanxi province in China saying, so how do we do these green bonds? What's green again? Have you got any solar loans? Yeah, we've got a few solar loans. There you go, you can do a green bond. And now we have banks incentivized to lend to solar because they can get access to lower cost capital and, cross fingers, they'll pass a bit of that saving on. But in the meantime, they're hunting for deals. We can do that in the system. There are many things we can do. We can do foreign exchange hedging. Here's Harold from TCX. This is a government-supported foreign exchange facility specifically designed to put downward pressure on the FX costs for emerging market issuance. We can do a bunch of things along those lines. So, the green bonds market is evidence that if we take deals to investors with the right risk and yield requirements, they will buy. A challenge for solar, new, relatively scary for investors. Ooh, solar, isn't that all policy risk? Didn't Spain wreck the market for us and send people bankrupt, et cetera, et cetera? We have some challenges in mitigating risk. We need different sorts of risk mitigation instruments to get through the challenge of growing the next few years. But in the meantime, if we can construct it as a green bond, they will buy. So this is the growth we've seen in different markets. USA is number one, thanks largely to one institution. Fannie Mae, last year, started offering discount loans to energy-efficient social housing. Discount loans. That's a cool idea, isn't it? There's an incentive. $24 billion of green bond issuance last year. We've seen China set up a market by government fiat. We've been working at the People's Bank there, for the central bank, for 4 years. In the beginning of 2006, there were no green bonds. There were 36 billion by the end of the year. There were 37 billion last year, despite the corporate bond market in China contracting 85% because they're deleveraging their balance sheets. We've seen a whole lot of countries grow. Sweden, where I was yesterday, is the world's largest per capita issuer of green bonds, with a lot of renewable energy in there. So that's what's in there. Yes, renewable energy is in there, but the way we get bulk, the way we get scale, the way we get headlines that makes the investors feel, oh, this is okay, it's large and safe and liquid, is we lump a whole lot of things together under a broad climate change rubric. So we have low carbon buildings, energy efficient buildings, we have water infrastructure, sustainable land use and forestry, et cetera, et cetera, et cetera. There's a whole lot of stuff in there, but of course at the heart, at the beating heart of this industry is solar. So you are no longer an orphan industry, which is how institutional investors see you. You are no longer a niche play because I know it looks big to you, but it looks tiny from the point of view of BlackRock and Allianz. You are now part, from the financing point of view, of a much bigger play, helped by the fact that now we've got a story to get governments to involve. So France last year issued 10 billion euros of green bonds. 10 billion euros, not bad. By the way, they got a very good price, which shocked them, totally shocked them. We have Belgium in the market now. We have Indonesia in the market now, the world's first sovereign green sukuk, somewhere between $1 and $2 billion of issuance. We have Sweden discussing it this week. the Ministry of Finance. We have 15 countries queuing up. That will provide liquidity and scale, and that will get headlines going. And we're getting something very interesting on the back of this. We're now getting countries phoning up and saying, so what's our green finance policy again? But what do we do here? How does, in Nigeria, we get access to some of this? We saw the first Nigerian sovereign bond in December, only $30 million to local pension funds. So we went to see the head of the local pension fund association. We thought this is going to be a hard sell. God. They said, we want green, please give us, we love green. Everyone gets green here. They sort of get solar, they sort of get forests, but they like green. It's an easy marketing concept. So the bond went like that. Whoosh, sold quickly in Nigeria. In Nigeria, it's a petrostate, for God's sake. So it's not only Nigeria. We have the same conversation in India. We have the same conversation in Colombia. Argentina is working on its first sovereign green bond. We've seen 3 issuance. It's a global phenomenon. It's not just rich countries. That's an opportunity for you guys. Now, how does this opportunity play out? Whichever market you're in, here are some of the jurisdictions that are involved. Well, I want to just go back to that original idea. We have a large green bond market. Okay, that figure's a bit higher now, but $220, $300 billion thereabouts. We have a climate-aligned bond market, which includes a whole lot of solar, which was issued before. I don't care about the difference. You can do one or the other moment, except that something interesting is happening, which is exactly what the game plan was. The demand for a simple marketing concept is now so strong, that we have things oversubscribed. I spoke to Commune Invest yesterday in Sweden. They got like 6 times the investors they need. When Greenco issued their $500 million green bond from India, they got 8 times the book. 8 times the book. So we have price movement. Now, we never expected price movement on the back of sentiment. Who's an investor in the room? Anyone? No investors. Oh, there we go. You're not going to buy solar because it makes you feel good, even though you want to do it, because you've got a credit committee you've got to report to. But because of the demand of individual funds coming in, and central banks now, the bigger this market goes, the more investors appear. The Central Bank of Peru now has an active policy of buying green bonds. We have a secondary market that's performing beautifully. So where we have currency issuance and liquidity and secondary market trading, euros, dollars, and renminbi, we see very distinctive, better pricing for green bonds on the secondary market. Very clear. And guess what? That translates into the bond being worth more in your portfolio. So that gives you a little bit of interest in maybe bidding tighter at primary, and you get downward pressure on primary. I can tell you this is real because I'm getting hedge funds phoning me all the time now. And hedge funds, they're not long-term investors, guys. These are guys who buy and flip. So they come in and they say, can you get me on that communist deal? Can you get me on that Bank of America deal? Can you get me on the Engie deal? I just want to buy maybe 100 million, that's all. I'll even give you a commission. I can't do that because we're an NGO. So why? Because they buy on day one and they flip 2 days and sell into the market because in the first 4 weeks after issuance, the price improves. Bingo, like that. There is strong downward price pressure. So what it means for you is, if you do something simple, if you can issue a bond, you've got to be able to issue a bond. If you're able to, you put a label on it, you've immediately got about an 80% chance of shaving 5 to 15 basis points off your cost of capital. That's it. That's one. 2 is, you will have this year access to a bunch of government support schemes for capital. We have the Swedish government rolling out a credit enhancement scheme purely for green bonds. We have TCX, Garant Co. looking at how they can focus on green bonds. We have different governments looking now, like the Chinese government, at regulatory support for green bonds. We have Vice President Dombrovskis announcing that there will be risk-weighting differential relief for green bonds in the European Union. That is, if you issue a green bond for electric vehicles or green mortgages, in the first instance, you will get, as a bank, a better leverage ratio. You are going to get a lot more incentives going forward for this. How does this work for you? Well, there's price. There is refi. These bonds, by the way, are refinancing assets, not project finance typically. There is now scope to bring in a whole lot of solutions in emerging markets to take access to these green bonds. We'll be doing aggregation projects where we try and set up a warehouse in Kenya. We're working with the Kenyan Banking Association and FMO to set up a refinancing warehouse for solar loans from banks. We're working, we hope this year, with Harold and the International Solar Alliance on a warehousing facility for the same thing. We will also, by the way, if you're a small issuer, if you're M-COPA doing notes, if you're Lendable, if you're B-Box, We'll be running investor events in Zurich, in Munich, and in Hong Kong, bringing potential green bond and green note issuers to meet high net worth individuals and family offices. So we're trying to create a market for 2 million to 30 million issuance. For the larger issuers, for those people or countries, we have, well, our first event this year is the 19th of March in London. We're bringing 14 Chinese green bond issuers to meet investors. These are big boys, right? ICBC, Bank of China, Goldwind. We'll do the same thing for India a month later. We'll do the same thing for Indonesia in Q3, in Brazil and Mexico in Q4. So if you're at the big end of town and you can do a big bond, that's your market. We're trying to drive issuance. Clubin, the largest agribusiness in Brazil, issued a green bond in New York last year. He, like every treasurer in the business, is sold because he got the best price he'd ever got. National Thermal Power Company for 20 gigawatts of solar in India got the best price they'd ever got. That's what we're seeing in this market. We're trying to create a marketing theme that works for you, a marketing theme that brings governments in and emboldens governments to take more aggressive measures to grow this industry because they do not have to pay it with taxpayer money. The money's there. It's over there, next to our moderator. $100 trillion of it, piling up in US dollar bills and euros. Over here's the projects. We now know what the scale is. It's simple now. It's simple now. We simply have to make the money flow across this bridge. And your cost of capital will keep going down. That's what we're doing. Join us. Make the capital flow. Otherwise, well, you know what the otherwise is.